The pound might be strong today, but tomorrow it could be really weak. And suddenly that trip that you've got planned to Paris might cost you quite a lot more pounds than you were expecting. Hi guys, welcome back to my channel. And today I thought I would teach you all about exchange rates. The reason why I'm doing this topic is I've taught exchange rates at university a couple of times now, and I think I've got down the common mistakes and pitfalls that students make, and I think I can make this topic a hell of a lot easier. So in this video, I'm going to give you examples, I'm going to show how it's determined graphically, I'm going to go through the different types of exchange rate regimes, and then we're going to have a bit of a chat about how a fixed exchange rate is actually maintained in practice. Because it isn't just that a country can wake up one day, decide to fix their exchange rate against another currency, and it just magically happens. There has to be constant intervention in the foreign exchange market. So stick around and let's make this topic really easy. So when we are talking about exchange rates, it follows the same principles that we have when you've done any kind of other economics. It's a supply and demand diagram. The only thing is the axes are looking a little bit different, and the intuition behind maybe supply and demand is, needs some work. So let's have a little think about this. So if we pretend that the home currency is the pound, and we're going to say that the foreign currency is the dollar, there's a couple of different ways I could express this as an exchange rate. I could do pounds per dollar. So let's say that was, I don't know, let's keep it simple. Let's say that's 0.5. What that says is $1 equals 50p, okay? So this is because the thing that's on the bottom of the fraction, the denominator, is it's per dollar. So it's always a 1 for the one that's on the bottom, so it's $1. If I had it as dollars per pound, and I had it as, I don't know, let's say 2, for example, then what that says is 1 pound equals $2, okay? So depending on which way round it is written, massively affects the exchange rate and how you would interpret it. Because if I just said to you, if you had confused these and I'd said the number got bigger, you wouldn't know which currency is appreciating, okay? So for example, if this 0.5 becomes 0.7, that's telling me $1 now buys me 70p, so the dollar has appreciated, okay? And similarly, if this becomes 3, so £1 buys me $3, it tells me the pound's appreciated. So understanding what we're talking about or which way around it is very, very important, and it is very, very important for your graph. So what we need to do is we need to think about the supply and demand diagram. Now, it depends on which currency you want this about, okay? So for the minute, I'm going to do a graph about the pound. So this is talking about pounds. But obviously, because it's exchange rates, we do need dollars in there somewhere, but ultimately it's a graph all about the pound. So the demand for the pound and the supply for the pound. Okay, so the graph that it's about, on this axis, we're going to have quantity of pounds. And on this axis, if it's about the pound, I want the pound on the denominator. So I'm going to have dollars on the numerator. And the reason for that is I want this to be able to be interpreted intuitively. So if this number goes up, I want it to be telling me the pound's going up. If it goes down, I want it to be telling me the pound's going down. So that's really, really, really important. Similarly, it just makes a little bit more sense when we have the demand and supply line. So I'm going to draw a demand downward sloping, and I'm going to draw standard supply upward sloping, okay? And then obviously here, this is our equilibrium. This would be the exchange rate. I'm going to call it E star. That would prevail if this was the situation. Okay, so what we need to do is we need to get our head around what does cause supply or demand to change. So there's a way to think about this. Demand. This is only affected when foreign holders, so people holding foreign currency, so foreign foreigners, I'm going to say, want pounds. That's the only time we're going to talk about demand. So if you already have pounds, you're not affecting the demand. It's foreigners wanting pounds because it's all about the foreign exchange. Okay, so for example, this could be foreigners want more of UK goods, or even less of UK goods. It's a way of changing the demand for the pound. There's foreign investment, more foreign investment in the UK. So that's the only time demand is affected. Okay, and that makes intuitive sense as to why we've got this downward sloping line. If we go down this line, this demand curve, that E falls, and bearing in mind this is talking about the pound, so as we go down, E gets weaker, okay? So if the pound is weaker against the dollar has better purchasing power, it can buy more pounds. Well, if you've got dollars and the pound's now really cheap, you'll buy more, you'll demand more. So that's why we go down here, the quantity of pounds you demand increases. That's why it's downward sloping, okay? Let's think about supply. What affects supply? So the only time we should be talking about supply moving is when you have pounds and you want how to word this? Home currency holders want foreign currency. Okay? That's when we affect supply. So this could be, for example, you import more. So if, that says more, there we go. If, I'm from the UK and for some reason I want to import more from the US, I'm affecting the supply. I think where people get confused is they think about supply of the pounds as like printing money. That's not what we're on about. This is about exchange rates. This is about imagine going to a shed and you're determining whether or not you're handing over pounds. If you're handing over pounds for foreign currency, you're increasing the amount of pounds in that shed, so therefore you're increasing supply. Whereas if you suddenly decide that you don't want to go to that shed as much and hand over your pounds because you want to hold on to them, you're decreasing the supply of pounds in that shed. Okay, it's not about printing money, and it's not about people with pounds, we're demanding them. There's nothing to do with that. So please bear that in mind. Okay, so that's what affects demand, that's what affects supply. For supply, this also makes sense because if we go up the supply curve, E gets higher, that means the pound's getting stronger, okay? So the pound is getting stronger against dollars. So what would you do then? If your pound's getting stronger against dollars, you could afford to buy more dollars, right? Okay, so let's try and illustrate this with an example then. So let's say the scenario is, so example one, we'll make it easy to start with. Example one, UK citizens import more US goods. So US goods have become much more attractive to the UK. I don't know, let's pretend the quality is a lot better. So what's happening here? This is people with the pound are wanting to switch it to dollars because that's the only way you can buy US goods, okay? So you're wanting to switch it to dollars. You're going to that shed and you're handing over your pounds for dollars. Well, when we have pounds, and that's the thing that's changing, it's supply. So supply of pounds is shifting out, okay? So what's happened here? We've seen E has fallen. This graph is all about the pound, and therefore the pound depreciates. But when we talk about exchange rates, it's in relation to another currency. So if one's going down, the other must be going up. So we must be able to say the dollar appreciates. Okay? So the pound depreciates and the dollar appreciates because the UK people are handing over their pounds to trade it for dollars to buy more US goods. Okay. So, given that then, obviously I decided that this graph was about the pounds. we should be able to do a graph about the dollars with the exact same scenario and be able to show the same outcome, but different curves would move. So let's do the exact same thing, but I'm now going to do a graph about the dollar because I think that really helps it make sense. Okay, so if we're now going to do the same scenario, but instead we're going to do a graph about the dollar, remember the graph needs to change slightly. So this is quantity of dollars, and we're now going to do pounds per dollars. Okay, so we still have the downward sloping demand and the upward sloping supply. That's never going to change. But we need to think about this carefully. So we're saying that UK citizens are importing more US goods. That was our scenario. What did that mean? What that means is the UK people are the foreigners in this graph, okay? So foreigners are wanting pounds, because the graph is about dollars now, not about pounds. In the previous graph, we would have said that dollars were the foreign currency. Okay, so when we're talking about foreigners, we know it's demand. So in the previous one, we shifted supply, but in this one, we're going to have to shift demand. Foreigners are wanting pounds. That's an increase. We're going to shift demand. Demand's going to shift outwards. Okay? So what do we see happening? We see we've gone from here to here. E has risen. This is a graph all about dollars. So the dollar has appreciated. The dollar has appreciated, which means the pound depreciates. So the outcome here is agrees exactly with what we got last time round, but depending on which graph you draw, depends on which curve you shift. And that really is important, okay? Let's try another example to really hit this home. Okay, so the scenario is going to be the following. So scenario, we're going to say, let's make it really appropriate. The US puts a tariff on the UK. So, what does this mean? This means that it's now much more expensive for the US to import goods from the UK. So it's more expensive for the US to import goods from the UK. So the US will import fewer UK goods. So let's see how that affects things. So we've got demand and we've got supply. And I'm going to do the graphs side by side to hopefully illustrate this better. So demand and supply. Okay, so let's do the graph about the pounds first. So the US is the foreigners in this graph because this is about the pounds. If it's about foreigners, it's always demand, and they're going to import fewer UK goods. Fewer means less. So demand has gone down, demand is going to fall, okay? So we're going to see a fall in demand, and we see E falls. This graph is all about the pound, so this intuitively tells us the pound has depreciated, which must mean the dollar appreciates. Okay? How will we then show this on the graph about the dollar? So, on the graph about the dollar, the UK are the foreigners. Okay? And what we are saying is, it's saying the US, they aren't really wanting to go and change their dollars up for pounds as much because they're not wanting to buy as many UK goods. So the US have their currency, they're not the foreigners, they're the home currency, in which case this is a supply side problem. So it hits the supply curve. And they are less willing to go and change their dollars up for pounds. So if they're going to that shed, they're not giving over as many, which means there are fewer dollars going into that shed, which means supply has fallen. So supply shifts to the left. And as you can see, E rises. This graph is all about the dollar, so this tells us the dollar appreciates and the pound depreciates. And that is what we'd expect, because these two outcomes have to match up. Your graph can look different depending on what you've done the graph about, but your outcome must be the same. Otherwise, it wouldn't make sense. You've got the same scenario, but you've got a different outcome. That just wouldn't make any sense. Okay? So hopefully that is very helpful. I'm going to do one more question where we have to shift both just to, make it harder, and then we will move on. So let's do the following. Okay, let's think about a scenario here. Let's say that interest rates in the UK are significantly higher than the US. So the interest rates in the UK have gone up and they're significantly higher in the US. So how does this affect things? Well, if you're thinking about trying to put money into a country to gain returns, you'd care about the interest rates. So if you think you could return, your rate of return in the UK would be a lot higher than the US, you would want to put your money in the UK. Now, if you already hold pounds, obviously you haven't got to do anything with your pounds. But if you hold dollars and you want to change them up for pounds, it's going to affect things. So let's think about how this could do anything. So let's think. People with dollars are now wanting pounds a lot more. Well, in the graph about the pounds, people with dollars are foreigners. And if it's a foreign, it affects the demand. So people with dollars are demanding more pounds. So we're going to see the demand curve shift. So we're going to see that happen. But what could also happen is if this changes, like the interest rates in the UK have suddenly gone up, you might say, well, people with pounds suddenly don't want to change them into dollars as much anymore. And if you've got the currency that the graph is talking about, it's a supply problem. So we could say we're less likely to give our pounds over for dollars, and you could say you also see supply shift up. In which case, what do we see happening? We see the exchange rate goes up. So the pound appreciates and the dollar depreciates. Okay? So that is how we'd illustrate that with the graph about the pounds. Let's do the same thing, but with the graph about the dollars. So now dollar is home currency, pound is foreign currency. So people with pounds don't want the dollar as much. They don't demand it as much. The foreigners don't demand it as much. So we're going to see demand shift downwards. Okay. Similarly then, what we're going to see is people with dollars, so that's their home currency, they're wanting to go to the shed and they're wanting to change it up for pounds. So we're going to have more dollars in that shed, which is supply. So supply is going to shift out. So what's the overall result here then? We see E has fallen. Well, this makes sense. The dollar depreciates, which is what we said earlier, so I'd expect that. And the pound, oh, that's going to be a pound. The pound appreciates. Again, what we expect. The two answers agree with each other, which is what should always happen. So just have a little think through. Think about what graph you're drawing. Everything should be intentional. And have a think about whether it affects supply or demand. Okay, so if you just allow the market, the foreign exchange market, to demand and supply to move wherever, and the overall result is the exchange rate, that's called a floating exchange rate. But some countries don't want a floating exchange rate. They want what's known as a fixed exchange rate. So, for example, they want their currency to always be worth a certain value against another currency. I'll do a whole other video on why that is the case and so on and so forth, but for now we'll take it as that. A lot of countries actually operate on what's called a managed float. So on most of the time, they're happy to allow their exchange rate to float, so it's just determined by supply and demand. But occasionally they intervene to avoid really large swings in their currency. So let's have a little look at this one. So let's take a graph about, let's pretend this is a graph about the Danish kroner, okay? And they like to fix or peg their currency to the euro. So let's have a look at this. So we've got the euro and we've got the Danish kroner. And this is a graph all about the Danish kroner. So let's say that they want their exchange rate to be 0.1. So 1 Danish kroner gets them 0.1 euros. The problem is just because you say that doesn't mean that that's what's going to happen. So let's put this here. 1 Danish kroner equals 0.1 euros. That doesn't mean that's going to happen because people supply and demand currency and these curves shift and you find that the exchange rate will change. So for example, let's say that people in Denmark suddenly demand a lot more goods from a European country. So I don't know, Germany, for example. Well, if that's the case, if they suddenly demand a lot more goods from Germany, they need to change up their Danish kroner for euros. Well, if they do that, they're supplying their Danish kroner, and you'll see that this happens, okay? Well, what really wants to happen here then, let's pretend this is, I don't know, 0.05, is the exchange rate wants to fall. The Danish kroner wants to depreciate, but Denmark doesn't want this. They want to maintain their exchange rate at 0.1. So what can they do about this? Well, they can intervene in this foreign exchange market. Okay, so what they can do is the central bank, or government, but central bank in this case, they have what's known as foreign currency reserves. So they are likely to have, for example, a lot of euros sitting there. So what they will do is they will use these euros to buy Danish kroner. So when you have a foreign currency, because even though they're in Denmark, they have euros, that's what we're talking about. They have the euros because they've set them in reserves, even though it's not their currency. And they're going to demand to switch them for the Danish kroner. It's a demand side, it's foreign currency. And they'll do so to an extent that hopefully brings their, essentially, if you do it graphically, it brings their line up to here to get the exchange rate at 0.1 so we can maintain this. So they would have to buy Danish kroner with their euros they've got in order to get their currency to 0.1. Now, hopefully you can appreciate that this is somewhat risky because if you don't have enough foreign currency reserves, if they didn't have enough euros, they wouldn't be able to do this, and therefore they wouldn't be able to maintain the fix. And when this happens, it's called, it could be a speculative attack, and you then forced to devalue your currency or depreciate your currency and allow it to float. So I'm going to do a whole other video on speculative attacks. But it isn't just they can wake up and say, well, 1 Danish kroner is 0.1 euros, and that is that. Because these will still change. Things will happen, and their currency would want to change as a result of that. But they'll have to intervene to rectify that situation. So I hope that makes sense.